Glyn, welcome to March's podcast.
Thank you.
A bare reading of the market returns would make it look like quite a dull month, but I think there was quite a lot behind the scenes.
Well, there was a lot going on behind the scenes. As you say, the broad indices over the month showed not a lot of activity, but in fact, there was quite a bit of nervousness as we went into the month. But things began to settle down a little bit, pick up as we got through the month. In fact, in the final 10 days or so of the month, we had really quite a strong run in markets, and intriguingly, particularly in emerging markets. So, yeah, there was a very distinct change in sentiment as the month progressed, and the month ended on a much stronger note than it began, quite frankly, because the first 10 days or so of the month was quite a tricky period in markets.
Main driving forces of the month, really, Ukraine, Russia,
Yeah.
Janet Yellen,
Yeah.
and China.
Yes.
Should we start with Russia?
Yes, well, that was the big issue that going into the month that was really impacting on markets, because it was in the early days of this month that effectively Russia annexed Crimea. It was pretty inevitable. We talked about that at the podcast last month. There was a process whereby Russia engineered a referendum in Crimea. As we had anticipated, the referendum, unsurprisingly, was 90% in favour of rejoining the Russian Federation. And Russia has now formally annexed Crimea, so to all intents and purposes Crimea is part of Russia, and I think that's absolutely inevitable. There's no going back on that. Lots of huffing and puffing by the West, but the real sanctions that would damage Russia would equally damage Western Europe, because Europe relies for roughly 30% of its energy supplies, natural gas in particular, from Russia. So there's been a great reluctance on the part of the Europeans to engage in any sort of formal sanctions that would be really damaging for Russia. So all that we've seen in terms of reaction from the West is some relatively minor travel and financial sanctions on individuals in the Russian sort of administration. However, having said all of that, there was a great deal of nervousness in markets initially because there was a fear that Russia might invade the rest of Ukraine, that Russia's ambitions might be to reinstate the parts of the Soviet Empire that it was regretting losing. All of those sorts of concerns were worrying markets, but I think realistically it's very likely there'll be a diplomatic solution to this. It's the only real solution. There's no military action going to take place between Russia and the West. That's absolutely clear. So I think there will be a diplomatic solution. And I think Russia has probably, although it's sort of pretty much ignored the West's protestations to date, it accepts that there does need to be some diplomatic solution that's been a move in that direction in recent days. Why? Because although the sanctions are not that significant to date, if they persist over time, they do get damaging. And look at what has happened in Russia. $70 billion of foreign capital has flowed out of Russia in the first quarter. The currency is down a long way. The stock market is down a long way. International confidence in the country has diminished substantially. A country basically ignoring international law is not a place you particularly want to invest. So Russia's got to reinstate itself into the international community again. So I think there will be a diplomatic solution to this. And as the month wore on, it became clear that that would be the most likely outcome. The problem is still there, but I don't think it's going to escalate into something that would be really damaging. And we must bear in mind that the biggest damage is going to be to the Russian and Ukrainian economies. In aggregate, they are not that big. They're less than the size of the UK economy. So even if they were to go into quite a sizable recession, that's not going to be damaging to the global economy.
Let's turn then to the US and Janet Yellen's first chair meeting.
Yes.
Few surprises in the meeting, but perhaps a surprise in the press conference.
That's exactly when the surprise came. No surprises in the meeting. The 10 billion per month tapering continued. Everybody expected that, so we're now down to purchases of 55 billion a month. Big number still, remember. But we're on track for that tapering process to end by the year end, so that by the year end the Fed will be doing no further asset purchases. On track for that, tick in the box. The other thing that was completely unexpected, this quantitative forward guidance that Bernanke had put in place, where he'd said some time ago now that the employment threshold would be 6.5% before they would consider an interest rate rise. That's now been dropped. Because remember, the tactic of the Fed has been to stop asset purchases, reduce them initially and stop them eventually, whilst maintaining forward guidance about the likelihood of interest rates staying very low for a long period. What they're now doing is focusing on much more qualitative issues, so much broader range of data that they're looking at relating to the labour market, the general conditions in the labour market, general conditions in the economy, inflation and financial conditions. So there are many more levers that they can now use to judge when they will raise interest rates. That was broadly expected. There was no specifics relating to that, but broadly expected, and frankly gives the Fed quite a lot of flexibility as to when they will raise rates. The issue that surprised the markets, was it a misstep? Who knows? But in the press conference after the FOMC meeting, Yellen, when asked the question, well, what does that mean in terms of the first interest rate rise? She said about 6 months after the end of asset purchases. Asset purchases will finish sometime later this year, probably, most likely. So everybody then assumed, well, that means that the first interest rate rise will be probably in the second quarter of next year, quite a bit earlier than people were thinking. And that, together with a little more sort of hawkish approach on interest rates, sort of surprised the markets and caused quite a bit of nervousness. What happened then is that both Yellen and other members of the Federal Reserve were at pains to stress that was not necessarily a target date, that it would be very much data dependent. Yellen herself referred to the fact that she thought that full employment would not be reached in the US until unemployment was around about the sort of 5.25%, 5.5% level, a long way from where we're at today. So a much more dovish tone came out in subsequent trading. So although the initial impact on markets was quite negative, the efforts by the Fed subsequently, I think, reassured markets that the first interest rate rise won't be until well into 2015. We still think it could be well into 2015 because there's still a lot of leverage out there in the US as elsewhere. This recovery that we're seeing in the economy remains relatively fragile. And I don't think the Fed wants to disturb that in any way. And the other thing is that inflation remains very subdued, so the Fed has got plenty of room to continue with very low interest rates without any real worries about pushing inflation up.
Right, let's move to the third issue that's been occupying the market's minds over March, China.
Yes, I think of the three that have been a concern to markets this month, this is the really big one that could be quite damaging to markets if it goes wrong. China has a particularly difficult problem. It set a growth target for the economy this year of 7.5%, and generally speaking, when China sets a growth target, it sort of gets there. At the same time, its longer-term objective is to liberalize interest rates, money markets, the currency. Then it's also wrestling with a credit boom. We could almost call it a credit bubble that has occurred since 2009, when there's been a huge amount of money thrown into the economy. Debt to GDP has gone up to over 200%, and the Chinese authorities are making it quite clear they want to rein that in. So they've got quite a difficult balancing act. What happened in the month was a couple of, I think, very important things. First of all, on the currency, they allowed the currency to weaken further, not dramatically, but remember, this is the first time the currency has weakened for several years. And they've widened the daily trading band on the renminbi from 1% to 2%. So to all intents and purposes, if they want to, they will allow the market to dictate the daily level of the renminbi going forwards. So it's another step in the liberalization process. Then we've seen a tightening in interest rates over a period of months. This month we saw the first ever onshore corporate bond default, not very big, $160 million, but it was the message, not the size, that was important. A message to investors that you're not going to be bailed out on lending money to weak borrowers. In fact, subsequently we saw 2 or 3 other defaults. So a very, very big message there. And the issue for the markets, and I think it is a very serious issue, is this tremendously difficult balancing act of unwinding this bubble, this credit bubble, whilst maintaining growth at these really quite good rates, sort of 7.5% or so. And I think that's going to be pretty tough. We're going to watch it very carefully as we go through the month. The Chinese market, as we know, has been a very poor performer. To put it in perspective, since the markets turned in March 2009, Chinese market's gone nowhere. Wall Street is up about 180% over that period, and a lot of other markets, of course. So You could argue there's a lot discounted here, but I think this is going to be a difficult year for China, and it has the potential to be quite damaging to the global economy. We saw a degree of that this month. The weak numbers coming out of China in terms of growth hit commodity markets. Copper was down 6 or 7% in the month. So this has a big impact globally, and something we're going to be watching out for very, very carefully as this year progresses.
Sticking on the economic side, let's move back to the US. It appears increasingly likely that the weather is making a big impact there.
Yeah, look, I think the data that's been coming out, people are treated with a degree of caution because it was such a bad winter in North America that it definitely hit activity levels, possibly by as much as 1% of GDP. So all the data that's been coming out has been treated with a little bit of caution. The data in the latter part of this month is beginning to show the economy is picking up again. The job creation numbers have been better. And I think as we go through the second half of the year, we're going to see more of that. I think the economy is on track for quite a good second half. We'll get through this difficult winter period, and as the numbers come out, not suggesting a boom in any way, but I think the fiscal headwinds are going to be less. There's going to be some pickup from this slack that occurred in the winter months. So I think we will see the numbers getting better as we go through the second half of the year. And I think expectations around that was what was driving Wall Street higher in the latter part of the month. In fact, Wall Street went on to reach a new all-time high again at the end of March.
So, looking back on the quarter, quite a choppy period all in all. Would you expect more of the same?
Yes. Intriguingly, I think to the surprise of many, government bonds, which did nothing in March, completely flat, actually outperformed equities in the first quarter because it was a pretty flat period for equities generally. I would expect more of the same. I'm encouraged by the fact that for the first time in a long time, in March, we saw emerging equity markets and emerging bond markets doing well. Emerging equity markets were up by over 3% in the month against an MSCI World Developed Markets that was basically flat. And that all happened in the last 10 days of the month, a bit more confidence coming back in, currencies that had been hit hard recovering. So I think that's a positive sign, and I think a lot of the negative news on the emerging markets is discounted. So I'm more positive about that, but I do think this issue in China remains a concern. There are definitely going to be bumps on the way as we go through a process that I've described earlier. If we see missteps from the Fed in this process of tapering, and tapering is definitely going to continue through this year, then that could certainly cause bumps on the way. And I'm concerned that we, in the debt markets in particular, we're seeing effectively lenders drop lots of requirements regarding covenants. We're getting back almost to the heady days of 2007 in some instances there. So, and valuations in the fixed income markets are high. I think we've got to be very careful about that. In other words, the returns we're getting in credit now really don't compensate for the risks that are being taken on. So I certainly think there are going to be bumps on the way. I think equity markets will make progress, having done really nothing in the first quarter of the year. This year, I think they will make progress, but there are enough issues out there to suggest that this is not going to be a straight line. There will be bumps on the way, but I would say the underlying sentiment has improved quite a lot over the course of this month.
Excellent. Thanks, Glenn.